I created a passive income stream to pay off my mortgage each month without lifting a finger. And you can do it too, believe it or not. In this video, we'll craft a plan to rake in around $2,500 per month. We will deploy 6 stocks to yield enough cash flow for a lot less investment than you'd think. I'll even toss in a link to a calculator that I developed for my own personal calculations and research. Check it out in the description and feel free to see for yourself how you can live off dividends. It's on the house. I'll help you crunch those numbers we're diving into in this video. Let's break it down. Can you guess what created over half of the S&P 500's total return when inflation was over 5% during the 40s, 70s, and 80s? It wasn't growth stocks or tech. It was dividends. Inflation is playing tag around 5% year on year, and we selected a portfolio that helps us beat that hands down without taking a huge risk. This is the strategy that's hit a home run from me, and I am here spreading good vibes. Do not treat this as financial advice. Do your own research and employ the tool provided in the description to blueprint your master plan. What are dividends? It's a portion of the company's earnings paid out to the shareholders regularly as a way of saying, "Thank you for believing in me." The payouts are either monthly, quarterly, semi-annually, or annually, but we will stay laser focused on monthly for a regular income stream each month. The board of directors at the company decides on the dividend amount. They might keep a portion, retained earnings, for company investments like expanding or developing new products or paying off debt. In my book, it's one of the top-notch ways to reel in some passive income other than real estate. Say goodbye to the hefty processing fees, maintenance, and other hassles that accompany real estate. If you want liquidity and diversification, dividends are the way to go. Reinvesting dividends snowballs the effects and makes it much faster for you to reach your final goals. Some might say it takes a stack of green to build an income stream through dividends. I'd rather cash down on my home mortgage. Well, sure, it's a path you can stroll, but here's my nugget of wisdom. I prefer to have my money hustle for me and pay me regularly to fund my mortgage, bills, etc., and also stay liquid for any rainy day fiascos. Plan and execute. Robert Kiyosaki of Rich Dad fame enlightens us that a house is a liability and not an asset, because an asset is supposed to put money in your pocket. So to take on a liability, you need to offset it with an asset. Essentially, you want those dividends to roll in and neutralize your liability, making the cash flow your financial counteraction. There are 2 broad ways to invest in dividends. Number 1, covered calls ETFs. Dipping toes into covered calls is like venturing into real estate. You find a family who wants to buy a house, but before buying, they want to lease the house for 3 years. As a homeowner, you'll earn regardless of twists and turns. This strategy works on the movement of time and not on the direction of stock price. Upside, you do not need a huge capital investment to earn a modest monthly income. Downside, these do get taxed as capital gains, landing in those loftier tax brackets. But guess what? So do your stock investments. Number 2, traditional. In the classic realm of dividend investing, you're snagging stocks or ETFs that have a track record of consistently doling out and boosting dividends. We're going to be mixing things up to boost those dividend earnings. To achieve that, we'll pull out the handy tool I created and walk you through its usage. Let's see what magic we can work together with this as you punch in the numbers based on your desired passive monthly earnings. Go ahead and punch in the numbers from row 4 to 11. For any ticker symbol, you can go to Yahoo Finance and pull in these. Once you have the numbers in, hit Run Time, Run All. This will output the end of year balance, dividend paid, taxes paid, and dividends reinvested. Remember that on line number 9, you will need to use 22 or 24 or 30% based on your tax bracket for covered call ETFs, as they are regularly taxed under capital gains. For traditional dividend ETFs and stocks, this will be 15%. If you would like a more elaborate monthly breakdown for all years, then hit the folder icon on the left, and under Sample Data, you will see an Excel spreadsheet called Dividend Reinvestment Calculator. Right-click and download this to see a monthly breakdown. Important tip: all investments that we are going to show you in the next section are better off when done daily, weekly, or monthly. This concept is called dollar cost averaging. This will make sure that you track and remain as close as possible to the stock price and limit your downside risk. I love using Webull for the flexibility of being able to make weekly recurring fractional payments. Robinhood is suitable for this purpose as well. You can find the links to open new accounts in the description below. I might get some commission through those links, which helps me support this channel, but it comes at no cost to you. RYLD. Everyone has heard of one of the most famous and everyone's favorite covered call ETF, QYLD, which tracks the NASDAQ 100 index. RYLD is a sister ETF to QYLD, designed to provide investors with exposure to US small-cap stocks, particularly those included in the Russell 2000 index. The fund aims to generate income for investors through a covered call strategy. RYLD is a very simple ETF. It majorly holds Vanguard Russell 2000 ETF VTWO and writes covered calls against it. Due to the high volatility of the underlying index, it currently pays out monthly at a distribution yield of 12.27%. Doing some maths here using our calculator, we start with an initial investment of $10,000, a monthly contribution of $300, yield of 12.27% for a period of 10 years. We will keep the tax rate at 24%. With these calculations and after tax, we will be making about $650 per month, with an ending balance of approximately $85,000. JEPI and JEPQ. JP Morgan Asset Management offers JEPI and JEPQ. Both of them are actively managed funds, with the likes of Rayner and Zingone as fund managers. While JEPI deploys a covered call strategy on the S&P 500 index, JEPQ selects from the NASDAQ 100 index. We will go with a 60-40 approach of investing in both JEPI and JEPQ to get a combined yield of 11.5%. Using our calculator again, after 24% tax, we will end up making about $600 per month for an ending balance of $82,000. NUSI. As the information technology sector continues to hold investors' attention and a huge boom in AI, the sector has received another boost from a relatively strong earnings season. As opportunities appear to be very much alive in tech heading into the fall months, NUSI, NASDAQ 100 Risk Managed Income ETF, looks very attractive for investors seeking high monthly income largely within the tech sector. The fund has given a distribution yield of 7.83% and utilizes a collar strategy to reduce volatility and downside protection. The strategy buys protective put options and write calls for the same security. Using our calculator again, after 24% tax, we will end up making about $335 per month for an ending balance of $67,000. Main. Buy this blue chip BDC and sleep like a baby. Main Street Capital is by far one of my most favored dividend stocks. The company's solid business model, commitment to shareholder value, and strategic investments have allowed it to maintain a strong financial position, ensuring reliability for dividend investors. Furthermore, Main's practice of steadily increasing its dividends distinguishes it from other stocks, providing an attractive option for those focusing on income-generating investments. The company's approach to balancing risk while securing high yields enables it to offer a substantial and consistent dividend yield, a key attribute looked upon by dividend investors. We go back to our calculator to punch in a 6.78% dividend yield and a tax of 15% for this, and see that we make approximately $320 with an ending balance of $67,000. Realty Income. A dividend aristocrat stands out as a beacon of reliability in the dividend investing landscape. Its focus on maintaining a diversified and resilient portfolio makes it a viable option for investors aiming to build and sustain wealth through a balanced approach to income and growth. Realty Income is famed for its monthly dividend payouts, a relatively rare feature in the stock market, earning it the moniker the Monthly Dividend Company. The company's commitment to delivering shareholder value is evident in its progressive dividend track record. To date, the company has declared 639 consecutive monthly dividends on its shares of common stock throughout its 54-year operating history, and increased the dividend 122 times since Realty Income's public listing in 1994. Let's summon our trusty tool again to see that for a 6.15% yield and a tax rate of 15%, we'll make approximately the same amount of money as Main Street Capital, of approximately $320 with an ending balance of $67,000. ADC. Agree Realty operates with a robust business model, focusing on acquiring and developing industry-leading properties, including those occupied by major retail giants. The company's portfolio is diversified, consisting of properties across various sectors, such as convenience stores, supermarkets, and restaurants, leased to tenants with strong financial standing, thereby mitigating risk and ensuring a steady inflow of rental income. An interesting fact about Agree Realty Corporation, ADC, is that it has a significant focus on retail properties that are deemed essential and are largely e-commerce resistant. This includes properties like convenience stores, supermarkets, and pharmacies. With an ending balance of approximately $60,000 and a yield of 5.43%, one can make about $230 a month after tax at 15%. Let's do some simple math and see how much we invested out of our pocket. Remember, these are very conservative numbers, as we have not accounted for share growth per year and/or dividend appreciation each year. If you recalculate using our calculator for a 20-year projection, you'll be blown away at the exponential gains and what compounding can do to your portfolio. Initial investment across 6 stocks, $60,000. Monthly investment across 10 years for 6 stocks, $300 times 6 times 12 times 10. That's $216,000. Total money invested, $272,000. Total balance with dividend reinvested, $428,000. Breaking it down per stock, we see that at the end of the 10-year period, should you choose not to reinvest the dividends but use them to pay your expenses each month, you will see RYLD pays $650, JEPI and JEPQ pays $600, NUSI pays $335, Maine pays $320, Realty Income also pays $320, and ADC pays $230, for a total of $2,455 per month. I get it, pals. Knowing that your liabilities are effortlessly covered by your assets rolling in the dough, it's like having a mental spa day. No more nail biting over keeping that 9-to-5 or the job market's roller coaster rides. Drop a comment below about your go-to dividend companies and how you're tangoing towards your financial runway. I'm always here, cheering you on and walking with you every step of the way. Catch you later.